Would you believe us if we said there's serious money to be made by investing in failing businesses?
Hmm.
And no, we're not talking about unethical giants. We mean companies that are truly struggling. Most people wouldn't even consider buying shares in a business that's headed for disaster. But that's exactly where short sellers step in. They specialize in trading what are known as unattractive stocks, or more specifically, stocks that are about to lose value. Sounds complicated, right? What does it mean to short a stock? And how is that different from a long position? In simple terms, short selling means you're betting that a stock's value will go down. It's basically the reverse of traditional investing. When you short sell, you're predicting that the stock's price is going to fall, so you borrow it and sell it when you think the value is near its peak. You might be wondering, how can you sell something you don't own? Here's how. Once you borrow a stock, you have temporary control over it, and you can sell it right away. But don't forget, you'll eventually need to return it to the actual owner.
Now that you've got a solid grasp of how short selling works, there's one big question left to answer. Is the potential reward worth the major risk?
And yes, there are conditions tied to that, but we'll get to them shortly. For now, remember that once you borrow a stock, it's temporarily yours to manage. Now, since the stock is in your hands, your goal is to temporarily sell it before its value starts to drop. Selling it while the price is high is absolutely key to short selling. When you temporarily sell the borrowed stock, you receive money equivalent to its current price. Now you just hang on to that cash and wait for the stock's price to lower. Once it does, you buy the same stock at a lower price, return it to the lender, and keep the difference. If the price drops all the way to zero, you keep the entire original amount. Not bad, right? If you manage to repeat this with hundreds or thousands of stocks, you could make a fortune. But easy there, cowboy. Don't go chasing falling companies just yet. First, you need to understand just how dangerous short selling can be. And spoiler alert, it might be one of the riskiest things you ever do. Possibly even more dangerous than diving into a swamp full of crocodiles. Please don't actually try that. One major risk of short selling is simply getting it wrong. If instead of falling, the stock price climbs, you're in serious trouble. The higher it goes, the more you'll need to spend to buy this stock.
Experienced investors often use both short and long positions to make the most out of their portfolios.
And keep in mind, you must return it to its rightful owner. Technically, your potential losses are unlimited since there's no ceiling to how high a stock can go. All right, you might think, I'll just wait until the stock eventually drops and return it then. Maybe I'll still come out ahead. Not so fast. There's another curveball. The lender can demand their stock back at any time. If that happens, you might lose not just your potential profit, but actual money too. Even if the stock price hasn't changed at all, you'll still owe fees for borrowing it. That's rough. But there is one saving grace in all of this. Remember when we said you could lose an unlimited amount of money? That's only true in theory, because something called a maintenance margin exists to reduce that risk. Here's how it works. Before you can short sell, you must put down a specific amount of your own cash as a sort of backup. This money acts as a safety net to cover possible losses. It's still your money, of course, but it's held as insurance in case things go south. This system gives both you and the lender a bit of breathing room when things don't go as planned. That depends entirely on your experience level. If you're a seasoned Wall Street veteran, you might make a killing shorting stocks. But if you don't know what you're doing, you could lose everything. And even pros occasionally miscalculate and lose amounts that are incredibly hard to recover. So does that mean short selling is only for financial wizards like George Soros? Actually, no. Short selling is a widely accepted part of trading strategy.
That said, like any high-risk activity in finance, short selling should be approached with caution, a clear plan, and most importantly, plenty of experience.